Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Laopu Gold Co. Limited annual report. Laopu Gold Co. Limited is a leading manufacturer and seller of high-quality jewelry products in mainland China, Hong Kong, and Macau. Their product line includes a wide range of items such as pendants, bangles, bracelets, rings, and ear studs, all designed to meet the diverse tastes and preferences of their customers. In addition to designing and manufacturing these beautiful pieces, Laopu Gold Co. Limited also offers maintenance and repair services for jewelry products, ensuring that their customers can enjoy their purchases for years to come. The company's commitment to quality is evident in its attention to detail and dedication to customer satisfaction. Laopu Gold Co. Limited sells its products through a combination of physical stores and online platforms, making it easy for customers to browse and purchase their favorite items from the comfort of their own homes. With over a decade of experience in the industry, Laopu Gold Co. Limited has established itself as a trusted name in the world of jewelry manufacturing and sales. The company's product offerings include gemset jewelry products with diamonds or other precious gemstones, adding an extra layer of luxury and sophistication to their already impressive range. With its headquarters located in Beijing, China, Laopu Gold Co. Limited is well-positioned to serve the growing demand for high-quality jewelry products in the region. Overall, Laopu Gold Co. Limited is a reputable and reliable provider of jewelry products and services, offering a wide range of options to suit every taste and budget. And Laopu Gold Co. Limited market capitalization of $116 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Laopu Gold Co. Limited holds a significant advantage in their industry. Laopu Gold Co. Limited trades at a higher price-to-earnings ratio of 20 times and a higher price-to-book ratio of 9.08 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 38% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 4.73%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company can be attributed to several key factors. The introduction of new product lines, such as diamond-inlaid pure gold jewelry and heat treatment of enamels, has contributed significantly to revenue growth, page 27. Additionally, product upgrades and high-quality development have also played a crucial role in driving sales, page 27. The expansion of online sales channels through flagship stores on Tmall and JD.com has been another major driver of revenue growth, page 27. Furthermore, the increase in the number of self-operated boutiques, with 45 locations in 16 cities, has also contributed to revenue growth, page 27. The company's ability to optimize its sales channels, including the utilization of self-cashiering systems, has led to faster trade receivables turnover and increased inventory levels, pages 19-20. The company's brand influence expansion, product upgrades, and market globalization strategy have also been key drivers of revenue growth, pages 14-16. The continuous expansion of brand influence, dominant market position, and strong sales performance in shopping malls have all contributed to the company's revenue growth. On the other hand, the primary drivers of revenue decline can be attributed to several factors. Extreme weather events, increased maintenance costs for boutiques, warehouses, and offices, higher insurance premiums, and changes in government policies and regulations affecting business operations have all contributed to revenue decline, pages 75-76. Additionally, customer attention to environmental impact and failure to keep pace with green market trends have also led to a decline in revenue. The company's financial performance has shown significant improvement over the past year. A notable increase of 234.9% was observed in net income, rising from RM 501,732 in 2024 to RMB 5,029,328 in 2025. This substantial growth indicates a strong revenue stream and effective cost management. Furthermore, the company's profit margins have also seen an upward trend. The non-IFRS adjusted net profit margin increased from 17.7% in 2024 to 18.4% in 2025. This marginal increase may seem modest, but it reflects the company's ability to maintain its pricing power and optimize its operational efficiency. The analysis of the company's financial performance reveals a concerning trend. Despite some instances where it appears to be generating positive operating cash flow, such as in December 2025, the overall picture suggests otherwise. The majority of extracted summaries indicate negative operating cash flow, with several instances highlighting unutilized portions and changes in net current assets and total current liabilities. This inconsistency raises concerns about the company's ability to sustain itself financially. While there are some glimmers of hope, such as potential positive operating cash flow if prepayments and deposits are utilized efficiently, these are not enough to outweigh the negative trends observed throughout the analysis. As a result, it can be concluded that the company is not consistently generating positive operating cash flow, which may have significant implications for its long-term viability. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, the total debt has skyrocketed from RM 0.37 billion in 2024 to a staggering RMB 6.26 billion in 2025, representing an increase of nearly 4 times. This substantial rise is also reflected in the percentage of total assets, which has jumped from 38.1% to 47.8%. Furthermore, interest-bearing bank and other borrowings have also seen a significant increase, rising from RM 0.37 billion to RMB 6.16 billion. The impact of this increased debt level on the company's financials is evident in its interest expenses. The company has incurred a substantial rise in interest expenses, jumping from RMB 30.13 million in 2024 to RM 138.85 million in 2025. This represents an astonishing increase of over 356% in finance costs. Additionally, the amount of interest paid has also seen a significant surge, rising from RMB 25.9 million to RM 119.92 million. These changes indicate that the company's debt level and interest expenses have undergone substantial transformations, which may have far-reaching implications for its financial health and future prospects. The performance of various segments or regions within the company has been mixed. On the positive side, the Chinese mainland segment has shown significant growth, with revenue increasing by over 204% and non-current assets rising by nearly 24%. This suggests that the company's operations in China are thriving. In contrast, the overseas region has struggled, experiencing a decline in both revenue and non-current assets. Revenue dropped by approximately 54%, while non-current assets decreased by around 61%. These numbers indicate that the company is facing challenges in its international markets. Management's outlook for the company is one of continued success and growth. The company's strong brand positioning, product style, and customer service have contributed to its market dominance. To maintain this position, management is committed to innovation, introducing new products such as diamond-inlaid pure gold jewelry and gold body lacquerware. In addition to product innovation, the company is also focused on sustainability initiatives. It aims to reduce energy consumption, promote green commuting, conserve water resources, and use environmentally friendly packaging materials. Management prioritizes suppliers who provide environmentally friendly products and services, demonstrating its commitment to ESG principles for long-term development. The company's goal is to build long-term trust with stakeholders and become a top gold jewelry brand with unparalleled competitiveness. By continuing to deepen the implementation of ESG principles, management believes that the company will achieve sustainable growth and maintain its market dominance. The company has a history of paying out dividends to its shareholders. In the year ended December 31, 2025, the final dividend was set at RM 11.95 per share, totaling approximately RM 112 million. This payment is in addition to the interim dividend for 2025, which was RM 692 million. The company's commitment to paying dividends demonstrates its financial stability and ability to reward shareholders. There are valid concerns about inventory buildup in the company's operations. Several pages highlight this issue, including page 19, where it is explicitly mentioned, and page 31, which notes the challenge of maintaining optimal inventory levels. Additionally, page 43 mentions incremental inventory costs arising from expansion, further emphasizing the concern. The supply chain disruption, however, does not appear to be a significant concern in these extracted summaries. While there are mentions of potential issues with market conditions affecting net realizable value, pages 104 and 133, these do not specifically relate to supply chain disruptions. The increased inventory levels and write-downs to net realizable value on page 152 suggest that the company is struggling to manage its inventory effectively, which could lead to further concerns about inventory buildup. Overall, while there are some mentions of market-related risks, the primary concern appears to be managing inventory levels and costs. That concludes the financial summary for Laopu Gold Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.